DEO has reported their earnings. Their price is towards their 52-week low. They're down 17% over the last year. Is this now an undervalued strong buy? Let's take a look. As usual, we will look at their top line growth year on year, their bottom line growth as well. We're going to take a look at the health of the company, total cash versus total debt. We'll also analyze how well they've performed versus their competitors over the last 5 years. We'll talk about their dividend safety. We'll look at dividend yield theory and some very strong financial metrics. We'll take a look at the institutional ownership, whether these institutions are buying quarter on quarter. We'll also run them through the insider buying and selling screener. And we will take a look at their earnings to see how well or how poor it just was. And don't forget, we will run them through the valuation model, getting to the intrinsic value as well as that acceptable buy price given Wall Street's forecast as well for the next 12 months. So let's take a look at their earnings and see what is going on with this company. They did report their interim reports for the half of fiscal 2024. Now, earnings per share came in down 7.1% year over year to just over $1. Now, a few different reasons. We have mentioned this when we have run through this company. Soft sales, lower organic operating profit, and a higher finance charge, although some of these were offset by reduced taxes and higher incomes from their associates and the impact of the share buybacks. So, not great. You don't want to be investing in companies where their earnings per share are declining year on year. But let's take a more holistic view. Let's look at other pointers as well. Their net sales also declined 1.4% year on year. And again, a few things to note with this company, given it is based in the UK. The currency impacts, it does have an effect on their top line. And we can see they did have a huge decline in the Latin America and Caribbean by 23.5%. Again, we have touched upon this as well. Reduced consumer demand from the macroeconomic pressures in the region. So a lot of things just to bear in mind. We have covered this when they did come out with that reduction, which they were expecting, although they had anticipated around 20%, not 23.5%. And a few things to note with their 2024 outlook, they do expect organic net sales growth in the second half to be better than the first half, although not massively gaining on that, just steady growth. So again, just something to bear in mind. Fiscal 1 of 2024 wasn't the greatest for DEO. They're hoping fiscal 2 is a lot better. So they are down 17% over the last year. Over the last 10 years, you would be up 22% on your position. It doesn't include those dividends reinvested. And we do see here they have hit their all-time high at the back end of 2021 at $217. Now, the trailing 12-month yield just below 3% and a forward PE of around 18. In terms of their top-line revenue, what we'd like to see, 3 to 7% steady growth year on year. 16.3 billion reported in 2019, 22 billion reported in 2023. So yes, nice growth over the last 5 years. I just would draw your attention to it hasn't been very consistent. 2019, it did fall in 2020, although you can justify that COVID year. On the more positive, it did bounce back following that drop. In terms of the bottom line net income, 4 billion reported in 2019, 4.7 billion in 2023. So their bottom line has increased by around 20% over the last 5 years. But again, it does follow that essential top line. It did drop in 2020, rebounded nicely into 2021, and then consistently increases after that. So yes, very mixed. We do understand COVID, the impact on the company, but nonetheless, it is still growing over the longer term. Very quickly then, total cash versus total debt, 1.3 billion of cash and short-term investments in 2019, 1.5 billion in their latest quarterly report. So they're holding a little bit more cash, around 10% more than they did 5 years ago. In terms of that total debt, well, 16 billion in 2019, 22 billion in their latest quarterly report. So their total debt is increasing at a faster rate than their cash. We will touch upon that shortly as it does impact the dividend safety and the net debt to EBITDA metric. So let's take a look at some others in the distillers and vintners industry. We have Constellation Brands, Pernod Ricard, and a few well-known others. So over the last year, including dividends reinvested, they are one of the worst performing. In fact, one of the middle performing, as the industry as a whole hasn't performed that well, down 15%. The best performing, as we can see here, Constellation at 9%. Over the last 5 years, when we take a more wider approach, they are up only 8%, and we can see in actual fact the industry as a whole hasn't been the greatest to have your money in over the last 5 years. Again, we do see Constellation the best performing, up 54%. Nonetheless, just because it's only been 8% over the last 5 years, it doesn't necessarily mean that is an indicator for future performance. So we have the institutional ownership now, around 808 million worth of sales by these institutions over the last 12 months. Over the same period, more than double the buys at 2.2 billion. So yes, institutions do quite like this company. They have been buying more than selling. And if we look particularly at 2023, Q1, a lot more buying as well as Q2. Q3, we see the opposite, but we do know in Q4, again, in the more recent quarter, more buying by these institutions. Always do notice, though, with institutional buying, you should essentially be doing your own due diligence and not just copying it. It is just one level of our research. We have run this company through the essential screener for insider buying and selling. Over the last year, there is nothing to note here. So let's jump into the dividend safety. A score of 99, very safe. Market cap 81 billion. Now it is a large cap company. Last recession, while they increased the dividends, they had plus 5% growth and they had a near recession return at negative 51% versus the S&P's negative 55%. Dividend growth, well, last full year, 5%. Last 4 years, or in fact, last 5 years, 4% on average year on year. Remember, we do see as a minimum, you want to be getting 4% just to keep up in line with inflation. And over the last 20 years, 6% year on year. One thing to note in more positive news, they are a dividend aristocrat. They have been increasing those dividends for the last 25 years. Dividend yield theory, we have a sign of a massive undervaluation with the yield above the 5-year average. Although do bear in mind, we never look at any of these models in isolation. Forward PE 18.4, again below that 5-year average, so we have a double sign of undervaluation. And we note the consumer staples sector PE is slightly higher at 18.9. Free cash flow payout, well, new viewers, you should note that we don't look at the earnings. It is susceptible to manipulation by management through accounting, so we focus on free cash flow. One example is 2023, which is the more recent year, 98% of free cash flow. If you looked at the earnings, it'd be 49. And what this essentially shows us that in 2023, management nearly paid out what they paid out in dividends, the same amount they generated in free cash flow. So a bit of a red flag indicator. Just better to note in 2024, they are expecting this to come down to 74%. Free cash flow, well, nearly doubled over the last 10 years. Important to note, it is very inconsistent over the longer term, but it does move in the right direction. And from 2021, it has been coming consistently down. 2024, they are expecting to see some growth finally at $1.09. Sales growth, well, we can see the last 3 years very strong. We do look for 3 to 7%. We also note that you could argue the cyclicality of the business with 3 years negative. In fact, that COVID year of minus 9%, we see that again in 2014. In terms of total sales, well, 10 billion in 2014, 17 billion in 2023. They have been increasing that by around 70% over the last 10 years, but it hasn't been consistent. So do bear that in mind in your own investment approach. Shares outstanding, they have done share buybacks, 2.52 billion, 2.27 billion. So they are buying back shares. They are returning excess cash to investor pockets. So that is nice to note. It isn't a lot, but it is nice that they have been buying back around 10% of those shares outstanding. In terms of ROIC, as always, my personal preference, 10% or more, gives us faith that management are able to effectively allocate their capital, and it is consistently fairly strong, so I would give that to management. It is a green tick next to their name when we are looking at our investment thesis. Margins looking very strong, pretty much 30% consistently year on year, above the minimum 16% for consumer staples. Free cash flow margin, while it has been more inconsistent, 11% in 2023 is still looking nice, and it is above that 7%. Given they have been struggling and hopefully will turn it around, we should see this number start to go up. Net debt to earnings before interest, tax, depreciation, amortization. Now remember, because this shows us the balance sheet strength and dividend safety, we did take a look at the balance sheet with that debt increasing faster than cash. Nonetheless, a score of 2.6, which means 2.6 years for them to pay off all of their debt, net of cash on hand. It is below that 4, so that is quite strong in my opinion. The dividend is safe for now. We do see a very safe score, and the balance sheet still looks to be secure. So in terms of the valuation, as always, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. We start off with Graham's valuation formula. Now we have the stock ticker symbol, the earnings per share, the growth rate per analyst estimates, and that corporate bond yield. We get an intrinsic value now below the market value. So we have our first sign of overvaluation. Do bear in mind that we don't look at any of these models in isolation. Multiples, we then have the earnings per share and P multiple of companies in a similar sector and size. Multiply the average P by that of DEO. We get an intrinsic value showing us our first sign of undervaluation. Then for the dividend discount model, now this is what they paid out in GBP. So we have the latest dividend increase, which came to $5 in total. Growth rate around 5% over the last 5 years, slightly higher than the average. We are a bit more optimistic about these increases, and we can see this does show that undervaluation signal. Discounted cash flow, we have the free cash flow year on year. We've gone forward looking in essential roughly what the average growth rate is, around 9.66. In combination with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get pretty much an overvaluation signal, although it is pretty much a few cents shy, so reasonable valuation. For the intrinsic value is just the average of the models that we see on the screen. So for today's episode, it does come to $154. Now, in terms of the current price, what we typically do is use a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see for a 10% margin of safety, it would need to be around $139. So it doesn't give us that 10% margin just yet. In terms of what Wall Street are forecasting over the next 12 months, well, they believe it to go higher than our calculated intrinsic value of around $166 price target and 14% upside. So right now for DEO, we see around 5% margin of safety pretty much at the current trading price. It isn't one that I will be looking to invest right now. For me to add this, it would need to be at a fairly significant margin of safety. But do let me know your thoughts in the comments below. Is this one you are adding to, or maybe one you have added to the past and are waiting for a further drop to add this again? As always, if you enjoyed the episode, smash that like button, hit the subscribe button. We'll see you all on the next one, and take care for now.